The number one factor for us is the question of employment rights and therefore the sustainability of Deliveroo's business model. But given we have that concern, it would then be really important for us, if we were to decide to invest, to feel that we could influence the future path of the company. And given the dual-class share structure, which in this instance, it's a particularly egregious, if you like, example of the dual-class share structure, where the chief executive has more than 50% of the voting rights, despite having a relatively small economic interest, that would mean that realistically, over the next 3 years at least, we would have very little influence over the path of the business. And so, given our concerns about the business model, that was simply too high a hurdle for us to be able to get over to be comfortable investing.
I guess taking both those factors into consideration here, I wonder to what extent this disappointing debut could scupper the UK's efforts to make London a more desirable hub for tech listings in the future.
I wouldn't jump to too many conclusions on the basis of one IPO in the first couple of days of trading. I think it's important to remember the context, which is that we've had a number of very successful IPOs in the UK over the last few months, and the bankers I speak to tell me there's a queue of IPOs ready to come through spring and summer. So it's true that Deliveroo has been particularly high profile and sits into that sort of tech platform bucket, which is an area where perhaps the UK market is underrepresented. I think there are particular issues with Deliveroo right now that have made this a slightly more difficult IPO for the bankers to get away and perhaps have had an influence on the first couple of days of trading. But I wouldn't jump from that to saying that there's a broader issue for the UK as an IPO market simply because of what's happened to Deliveroo.